A major tech company just burned through nearly $300 million in research and development over a 6-month period, generating just a fraction of that amount in actual revenue.
Right.
And on paper, that sounds like a financial disaster. I mean, you would think their margins would be in a total freefall.
Oh, absolutely.
But here's the counterintuitive reality. Their profit margins actually went up.
Yeah.
So, okay, let's unpack this.
It sounds paradoxical on the surface, but when you look at the underlying mechanics of how artificial intelligence is being monetized right now, it paints a very clear picture of where the entire industry is heading.
Right.
We're moving past the novelty phase and entering the era of, well, brutal industrial-scale unit economics.
And to see those unit economics in action, we are going on a deep dive into the raw financial DNA of MiniMax.
Yes.
We are looking at 2 official documents released on August 26, 2026, a press release from MiniMax News, and their official 38-page interim consolidated financial results filed with the Hong Kong Stock Exchange, stock code 0100. Our mission today is to look under the hood of a frontier AI company that is aggressively transitioning from a research-heavy hype cycle into a massive global commercial operation.
And financial filings of this magnitude are incredibly valuable. They force a company to strip away the glossy marketing interface and show you the actual machinery.
The raw data.
Exactly.
Oh.
You see the raw server costs, the geographic footprints, and the strategic bets they're making with their cash.
Well, the numbers in this filing are massive. They basically distilled an entire year's worth of business into 6 months.
Right.
For the first half of 2026, MiniMax's total revenue hit $116.6 million US dollars. If we look at the first half of 2025, they only made $30.4 million.
Wow.
So they grew their revenue by an astronomical 283%.
That is just huge.
Yeah, in fact, they completely eclipsed their entire 2025 full-year revenue, which was only $79 million, in just one half of the year.
Hitting that kind of velocity requires a fundamental shift in business model.
Right.
I mean, a company doesn't triple its revenue that quickly just by signing up a few more casual users.
Right.
The composition of that revenue tells the real story here.
Yeah, that is what really caught my eye. The consumer-facing stuff, so the AI-native products like Helu AI and Talkie, they did well. That segment grew about 100% to $42.6 million.
Okay.
But their open platform and enterprise services absolutely exploded. We are talking about 703% growth.
Oh, wow.
Yeah, reaching $73.9 million. Enterprise went from making up 30% of their revenue last year to over 63% now.
That pivot is the defining characteristic of a maturing AI company. What's fascinating here is what that shift actually represents.
Right. Let me try to put a framework around this because I think a lot of people still view AI through the lens of a consumer chatbot.
Totally.
It seems to me that MiniMax realized they don't want to just be the company selling a flashy sports car to a few early adopters.
No.
Instead, they want to be the manufacturer building the high-performance engines and then selling those engines to every other car company on the planet.
So they can put them in their own vehicles. Right.
Exactly. They are selling the infrastructure, like the APIs and the token plans, to developers and corporate businesses.
That is a highly accurate way to look at it. The 703% increase in enterprise revenue is a direct reflection of increased API call volumes and the mass adoption of their token plan.
Right.
It means corporate clients are taking MiniMax's foundation models, like their M3 text model, out of the experimental sandbox. They're integrating those models directly into their own production environments.
Which changes the dynamic of the revenue entirely.
Yes.
Because if I'm a regular consumer and I get bored of an AI tool, I just cancel my $10 monthly subscription. The revenue is fickle.
Very fickle.
But if I am a listener running a logistics company and my engineering team integrates the MiniMax API into our internal routing software to predict supply chain disruptions, I am not ripping that code out on a whim.
Oh, not at all. The switching costs for an enterprise become monumental.
Yeah.
Once an API is hard-coded into a company's daily workflow, it becomes foundational infrastructure.
Yeah.
As that company grows and, as they process more data, they inherently consume more AI tokens.
Makes sense.
That creates an incredibly sticky recurring revenue stream for MiniMax. The enterprise client is locked in, and the token consumption scales automatically with the client's business activity.
And if these enterprise tokens are scaling automatically, it implies that this infrastructure is running 24 hours a day, 7 days a week.
Right.
Time zones effectively stop mattering when your product is an automated API. which brings up a really fascinating transition into their geographic footprint.
Yeah, let's talk about that.
Because MiniMax is headquartered in Hong Kong, they are listed on the Hong Kong Stock Exchange. Yet almost 61% of their revenue, which is nearly $71 million, comes from what the filing broadly categorizes as the rest of the world.
Right, outside the Chinese mainland.
Exactly.
The Chinese mainland still accounts for a healthy 39.2%, roughly $45.7 million. But the international dominance is a critical data point.
They are now serving over 300 million users and 1 million developers and enterprises across more than 230 countries and regions.
It's staggering.
The speed of that global expansion is hard to wrap your head around. If a physical hardware company wanted to launch a product in 230 countries, it would take a decade of building supply chains, distribution centers, and shipping logistics.
Oh, at least a decade.
But MiniMax operates like a local indie band that suddenly has a massive stadium tour booked in every single country simultaneously, purely because their music was distributed digitally.
Right.
The friction of physical logistics just does not exist for them.
Digital intelligence operates with zero physical shipping costs. When MiniMax pushes a model upgrade, for instance, their MiniMax Speech 2.8 or their Music 3.0 models,
Yeah.
that new capability is instantly available to a developer in Brazil, a logistics firm in Germany, and a banking client in Singapore.
That is wild.
But this requires an incredibly sophisticated technical foundation. You cannot just serve 230 countries with a monolingual model.
Oh, of course not.
The infrastructure has to manage massive global latency challenges, and the models themselves must possess a deep, seamless understanding of cross-cultural and multilingual context.
And it also provides a massive strategic shield. I mean, if you are a listener running a global tech stack, you want to know your vendors are resilient.
Absolutely.
By diversifying their revenue across 230 countries, MiniMax is effectively de-risking their entire operation.
Yes.
If one specific regional economy enters a recession, or if a single country implements strict new regulatory headwinds against AI, MiniMax has a 229-country buffer to absorb the financial shock.
Geographic distribution is the ultimate hedge against localized volatility.
But reaching all those countries and building models capable of understanding dozens of languages seamlessly is not a cheap endeavor.
No, it's incredibly expensive.
To really grasp the sheer scale of this operation, we have to look at the burn rate. We have to look at the true physical cost of generating digital intelligence.
The numbers in the R&D section are where the reality of the AI arms race becomes very clear.
Yeah, they are staggering. Their research and development expenses shot up 138.8% to $296.9 million for the first half of the year.
Wow.
The filing notes this massive spike is driven primarily by cloud services used to train their models, specifically the MiniMax M3 and their new open weights video model, MiniMax H3.
Right.
And because of that aggressive spending, their adjusted net loss effectively doubled from roughly $139 million in the first half of 2025 to $293 million in 2026.
Yeah.
Their total unadjusted loss for the period sits at $358 million.
Which is actually a slight improvement from the $402 million loss in the same period of 2025.
True.
But it remains a substantial amount of capital flowing out the door.
So if I am a skeptic looking at this balance sheet, I have to ask, is this actually a sustainable tech business?
Right, that's the big question.
They are spending nearly $300 million just to invent the technology, and they are only pulling in $116 million in revenue. Are they just shoveling hundreds of millions of dollars into a giant compute furnace to stay relevant against their competitors?
Well, if we connect this to the bigger picture, you have to look at the concept of research and development efficiency that they specifically highlight in the filing.
Okay.
While the absolute dollar amount of the loss is high, the relative growth rates tell a very different story.
What do you mean?
Their R&D spend grew by roughly 139%. Their revenue, however, grew by 283%.
Oh, I see. So the top line is accelerating twice as fast as the burn rate.
Exactly. The gap is mathematically closing.
Okay.
To understand why that gap is closing, you have to understand the difference between training a model and running a model.
Right.
The upfront costs in AI are astronomical. When MiniMax trains a frontier model, they are renting tens of thousands of highly specialized GPUs in massive data centers.
Yep.
They are running those processors at maximum capacity for months on end. That is the $300 million compute furnace you mentioned.
And the open weights video model, the H3, has to be a huge part of that furnace.
Oh, definitely.
Let me see if I have the mechanics of this right. When you train a text model, The AI is essentially just predicting the next most logical word based on human language patterns.
Yes.
It's mathematically intense, but it's relatively contained.
Right.
But when you move to video generation with something like H3, the model isn't just predicting a word. It has to generate 30 high-resolution frames every single second.
Yes,
It
exactly.
has to calculate lighting, physics, and spatial temporal consistency so that a character walking across a street in frame 1 doesn't randomly melt into a puddle in frame 30.
That happens a lot in early models.
Right. The amount of matrix multiplication required to simulate actual reality over time must demand an exponentially larger compute footprint.
You are touching on the exact bottleneck of multimodal AI. Video generation requires the model to hold a coherent understanding of time and space across thousands of sequential frames.
Yeah.
It is computationally brutal. Furthermore, the H3 is an open weights model.
Yeah.
By releasing the weights openly, MiniMax allows the global developer community to download and run the model on their own local hardware,
Wait, why would they do that after spending millions to build it?
because it creates an industry standard.
Yeah.
It gets the H3 architecture into the hands of millions of developers who will build tools on top of it.
Ah, okay.
While those developers shoulder the compute cost of running the local open weights version, MiniMax still had to absorb the staggering initial cost to train it.
Right.
However, once any of these models, text, audio, or video, finish their training phase, they become digital assets.
Yeah.
MiniMax pays the massive upfront cost once, and then they harvest revenue repeatedly every time one of their 1 million enterprise clients makes an API call.
Oh, wow.
That is the monetization engine outpacing the training costs.
Even with revenue growing faster than expenses, a $300 million half-year R&D habit is tough to sustain. I mean, how do they actually chart a path to true profitability?
Wow.
The filing points to a quote from the CEO, Dr. Yan Junji, that frames this entire dilemma perfectly. He stated, "Intelligence can scale almost without limit. Energy and compute cannot."
That tension between infinite software potential and finite hardware reality is the defining challenge of the decade.
And he provided a wild statistic to back it up.
Yeah.
From January 2026 to July 2026, the volume of token consumption on the MiniMax platform grew by 20 times.
That's massive.
A 20x increase in volume in just 6 months. Yet their gross profit improved 464.8% to $20.8 million.
Right.
And their gross margin expanded from 12.1% to 17.9%. The filing credits this margin expansion to improving infrastructure efficiency.
This raises an important question about the physical limits of AI.
Yeah.
When Dr. Yan Junji acknowledges that compute cannot scale infinitely, he is laying out a strategy that prioritizes inference efficiency.
What does that mean exactly?
The goal is not just to build the smartest model in a vacuum. The goal is to build a highly capable model that is remarkably cheap to operate.
Oh, that makes me think of the airline industry.
How so?
Well, if you want to fly more passengers across the ocean, you don't necessarily build a massive, incredibly heavy airplane with engines that burn through fuel at an unsustainable rate.
Right, that would be terribly inefficient.
Exactly. You spend your engineering budget figuring out how to make the fuselage out of lighter carbon fiber. You optimize the aerodynamics.
Yeah.
You make the plane lighter and more efficient so that every trip burns less fuel, and your margin on every single ticket sold goes up.
That analogy tracks perfectly with algorithmic optimization. In the AI space, making the plane lighter means optimizing the software architecture,
Okay.
using techniques like advanced KV caching or mixture of experts so that the model doesn't have to activate its entire neural network to answer a simple question.
Oh, I see.
Squeezing more intelligence out of the exact same hardware footprint is how you turn a profit. When MiniMax expands their margin to almost 18% despite a 20x jump in token usage, it proves their engineering teams are mastering inference efficiency.
They are delivering more work with less computational effort.
Exactly.
And speaking of doing more with less, there is another line item here that really stood out. Their selling and distribution expenses, which is basically their marketing and sales budget, actually dropped by 17.9% down to $27 million.
That is a very strong signal.
The filing explicitly states they are relying on an organic user growth strategy. It is like a new restaurant that makes food so undeniably good, they completely eliminate their advertising budget because people are just lining up around the block organically.
Cutting your marketing spend while simultaneously growing your revenue by 283% is a massive indicator of product market fit.
Right.
When enterprise APIs function seamlessly and deliver cost-effective inference, developers talk to other developers.
Yeah, that makes sense.
In the tech community, organic word of mouth regarding infrastructure reliability is far more persuasive than any traditional corporate marketing campaign.
Still, optimizing margins and relying on word of mouth only gets you so far when your R&D burns hundreds of millions of dollars. They need a massive amount of capital to sustain this momentum.
Absolutely, they do.
As of June 30, they had a very healthy cash war chest of 1.32 billion US dollars. But if you look at the events after the reporting period section in July 2026, they went out and raised an absolute mountain of new capital.
Yes.
They secured roughly 9.44 billion Hong Kong dollars through a share placing and another 6.43 billion Hong Kong dollars through convertible bonds due in 2027.
Injecting that level of liquidity into a balance sheet post-reporting is a definitive, aggressive maneuver.
I am really curious about the mechanics of this specific raise. Why issue convertible bonds due in 2027? I mean, a convertible bond is essentially a loan. It's debt that pays interest. But the investor has the option to convert that debt into actual equity shares in the company later on. It feels like MiniMax is offering investors downside protection today, with the promise of massive upside potential in a very specific 3-year window.
Yeah.
Why 2027? Are they bridging their finances toward a massive IPO event, or do they see a timeline where artificial general intelligence benchmarks fundamentally change the valuation of the company in 3 years?
You are looking at the strategic horizon perfectly. In the AI sector, a 3-year timeline is an eternity.
Right.
Issuing convertible bonds allows MiniMax to secure billions in immediate funding to buy compute power today without massively diluting their current equity valuation. It is a bridge.
A bridge to 2027.
Yes, by setting the maturity for 2027, management is signaling extreme confidence that their enterprise revenue engine will either achieve deep profitability by that date, or they will have developed next-generation models that justify a significantly higher valuation for an IPO.
Wow.
This capital secures their oxygen supply. It allows the engineering teams to push the boundaries on multimodal models without management constantly looking over their shoulders, worrying about a short-term cash crunch.
So, to synthesize everything we have unpacked from this financial filing for our listeners.
Yeah.
MiniMax is currently the ultimate case study in how an AI company matures and survives.
Definitely.
They are successfully executing a hard pivot away from consumer novelty toward building heavy, deeply embedded enterprise infrastructure. They have expanded their digital footprint to 230 countries, completely neutralizing their reliance on any single regional economy.
Right.
And they're raising billions of dollars in strategic capital to fund the immense physical compute required, all while actually improving their profit margins through relentless software efficiency.
They are proving in real time that scaling digital intelligence aggressively is entirely possible, provided the company remains obsessively focused on lowering the cost of inference.
Which brings me to a final thought I want to leave everyone with. It is drawn directly from the Business Outlook section of their filing, and it ties this entire conversation back to the listener's daily life. The document explicitly notes that AI models are moving toward taking sustained responsibility for complex, multi-step tasks.
Yeah, that's a huge shift.
We are no longer talking about a human prompting a chatbot to draft a single email. We are talking about agentic workflows.
Right.
We are moving toward a reality where an autonomous AI agent is deployed to manage an entire corporate supply chain, negotiate vendor contracts, and route logistics without any human intervention.
That paradigm shift will alter the consumption of compute power on a scale we have not yet witnessed.
Right. And remember the stat we discussed earlier. Token consumption went up 20 times in just 6 months before agentic workflows were even the industry norm.
That was just from traditional API usage.
So project this forward. Think about the 1 million developers and enterprises currently using MiniMax.
Yeah.
If every single one of those corporate users transitions from asking an AI simple one-off questions to deploying autonomous AI agents that execute massive multi-step workflows 24 hours a day, 7 days a week, what happens to our physical infrastructure?
The demand curve for electricity and server capacity will be unprecedented.
Exactly. The CEO, Dr. Yan Zhenji, warned us in this very filing that intelligence scales, but energy and compute do not.
Right.
We started this conversation by looking at the staggering $300 million spent on R&D. But the real question going forward isn't whether the software can get smarter.
No.
The question is whether the physical power grid can generate enough electricity to keep the data centers running when millions of AI agents take over the global economy.
Yeah.
Will the ultimate bottleneck for the artificial intelligence revolution be human ingenuity, or will we simply run out of electricity before we run out of ideas?